Right now, Plug Power Inc. is trading at $2.62, and it is down a sharp 4.03% on the day. Now, this is the entire story of this stock, wrapped up in one day of trading. The expectation, just a couple of days ago, was that the company's third-quarter earnings report was the moment things would finally turn. In after-hours trading, when that news hit, the stock rocketed up over 11%. The market saw a slight beat on earnings per share and, more importantly, a new strategic direction, and it breathed a sigh of relief. The reality? That relief was temporary. Today, that entire 11% pop and then some has been erased. The market has had time to read the fine print, and it is clear the skepticism is back in full control. This whipsaw action tells you everything you need to know. This is a battlefield stock, and the narrative is fighting a war against the balance sheet. For years, the common belief about Plug Power was one of future promise. This was the company that was going to put green hydrogen on the map. It was going to power the forklift fleets for Amazon and Walmart. It would provide stationary power for data centers, and it would fuel a new generation of long-haul trucks. This narrative was so powerful that it took the stock from a 12-year low of just 70 cents this past May and sent it screaming over 200% higher. Investors, many using accessible platforms like the Robinhood app or SoFi Invest, piled in, believing they were getting in on the ground floor of the next big thing, much like early investors in Tesla stock. They saw a low share price and a massive total addressable market. But the reality, the one that the professional investing class has been pointing to for years, is that the company's financials are, to put it mildly, a disaster. The idea has always been compelling. The execution and the math have been a persistent nightmare. Let's break down that earnings report because it's the epicenter of this recent volatility. The 11% jump in after-hours trading wasn't really about the tiny EPS beat. It was about a massive strategic pivot. First, Plug announced it was suspending its activities related to the $1.7 billion Department of Energy loan program. For months, the market viewed that loan as an albatross. It signaled the company was going to continue its deeply capital-intensive, complex plan to build out its own hydrogen production network. By backing away, the new management team signaled a shift. Second, they announced they would buy hydrogen from a major unnamed industrial gas partner. This is a move toward a simpler, less cash-intensive model. Instead of building the entire ecosystem, they'll focus on their core technology and buy the fuel. Third, and this is critical, they announced a deal to monetize electricity rights in New York to a data center developer, a move expected to generate over $275 million in cash. Why did this matter? Because it's $275 million in non-dilutive cash. The market cheered this. It sounded like a new, more sober management team was taking over. In fact, that's exactly what's happening. CEO Andy Marsh, who has been at the helm for 17 years, is stepping down to be replaced by the current Chief Revenue Officer, Jose Luis Crespo. The market initially saw this as a complete house cleaning, a new strategy, new cash, and new leadership. This was the expectation. So why the 4% collapse today? Because the reality is setting in. The market has had time to digest the rest of the report. The revenue number was a miss against forecasts. You cannot just cut your way to growth. This new simplified strategy is also a profound admission of failure. It's an admission that the original, vertically integrated plan, the one they've been selling to investors for a decade, was too expensive and was not working. And then there's the balance sheet. The cash burn remains terrifying. The company burned through $127 million in the third quarter alone. While that's an improvement, it's still a massive outgoing flow of capital for a company with a shrinking cash pile. Gross margins are still deeply, profoundly negative. Think about that. They are still not making a profit on their core product. This isn't NVIDIA stock grappling with high demand. This is a company that has not figured out its basic business model. This brings us to the core issue for every single long-term holder: dilution. Over the past year, Plug Power's total shares outstanding have grown by nearly 35%. This is a staggering figure. Any investor, whether they are managing their own individual brokerage account or checking their SoFi active investing platform, can see that their slice of the company is constantly shrinking. The company is forced to issue new shares again and again just to keep the lights on. That $275 million data center deal wasn't a clever strategic move. It was a desperate necessity, because the market has signaled it will no longer tolerate this level of dilution. Comment below if you are currently holding Plug Power shares and what your average cost basis is. It's a question many investors are asking themselves as they watch this volatility. This stock is not being driven by fundamentals in the way that Apple stock is. It's a technical and sentiment-driven trading vehicle. The short interest is over 30%. This is not an investment. It's a war between believers and skeptics. That 200% rally from the lows was a classic, brutal short squeeze. Today's drop is the shorts, many of whom are using sophisticated tools on the Interactive Brokers platform, re-establishing their positions, betting that the company cannot reach its goal of gross margin break-even by the end of 2025. They are betting the company will run out of cash before it runs out of promises. The professional analyst community is firmly on the side of the skeptics. You can log into any major Fidelity or Schwab terminal and see the consensus. It's a hold. But the price targets tell the real story. Morgan Stanley has a target of just 50 cents. Morningstar's fair value estimate is $1.50. The average analyst price target is below the current trading price. This is a rare and deeply bearish signal. This disconnect explains who owns the stock. Only about 38% of Plug Power is owned by institutions. While big names like Vanguard and BlackRock are on the list, it's a very low percentage for a company of this scale, most likely held in broad Fidelity mutual funds or Fidelity ETFs that track a specific index. The majority, over 56%, is held by the general public. This is a retail-heavy stock, which is why it's so volatile and why it's a popular name on Robinhood stock trading lists. You have a massive base of retail investors who believe in the green hydrogen story, and a massive wall of professional short sellers who are looking at the negative cash flow and the 35% dilution. This is why a passive investor using a set-it-and-forget-it intelligent portfolio or one of the Schwab intelligent portfolios would never be put into a stock like this. It is the definition of high-risk speculation, the kind of thing reserved for the self-investing portion of an account. So what does Plug Power actually do? For all this financial drama, the company is a leader in hydrogen fuel cell or HFC systems. Its core business for years has been GenDrive systems, which are HFC units that replace traditional batteries in material handling equipment, primarily forklifts. Its big-name customers like Amazon and Walmart use them in their massive distribution centers because they can be refueled in minutes as opposed to the hours it takes to charge a battery. This is a solid, tangible business. The problem is it's not profitable, and it's not a big enough market to justify the company's past valuations. The expectation was always built on the expansion plans, becoming a major producer of green hydrogen through its electrolyzer business, and providing stationary power for massive energy users like data centers. This new earnings report suggests they're pulling back from the production part and trying to lean into the data center angle as seen with the $275 million cash deal. Looking forward, the picture is brutally clear. This is a binary bet. The primary risk, the overwhelming reality, is the cash burn. The company must hit its target of achieving gross margin break-even by the fourth quarter of 2025. If it fails, or if the market doesn't see a clear and rapid path to get there, the stock will face immense pressure. The company will be forced to dilute shareholders even more at these low prices or face a genuine solvency crisis. This is what that going concern warning was about in the past. The execution risk is astronomical. On the flip side, the potential catalyst is twofold. First, the new simplified strategy actually works. Buying hydrogen from a partner immediately slashes their costs and improves margins, allowing them to focus on their core tech. Second, and that 30% short interest. Any genuinely positive, unexpected news, a massive new data center contract that isn't